All right, well, welcome to Chapter 8, where we'll talk about investments today, primarily how we record investments in debt or investments in equity of other organizations, and how it's presented on various financial statements. So investments are, anytime we purchase an asset or any other asset worth value with the plans of keep them from a long period of time for hopefully a gain of some sort when the asset is sold. For our balance sheet, they're always either short-term or long-term, as you understand from our classified balance sheet, where anything that's typically invested for 12 months or less are considered short-term investments, and anything more than 12 months are considered long-term investments. So you'll see on the balance sheet on your screen right now is that they are found in both categories of assets on the balance sheet. Okay, so this is just a snapshot of what we just said, under 12 months or over 12 months versus short-term versus long-term. All right, so when you come into investing in businesses, you can sometimes invest money to someone else, and so you lend it, and that's considered debt, where they will buy back or pay you back for that debt, those amounts that you've invested in them over a period of time. Or sometimes you might buy equity in the company. So you might get a percentage portion of an organization, either by buying common shares, or it could be a public corporation that you buy a portion of, and that's considered an equity investment. So when we look at investing in an organization, you typically have an intent for that investment. Do you plan to just generate investment income and you have no intent on having a long-term relationship or influence over that organization? That's considered non-strategic. So it's not aligned technically with your strategic goals of the organization to invest in that business. So it's considered non-strategic. Another investor may want to establish a long-term relationship or gain influence or control over that other organization. And that's considered a strategic investment. So perhaps it aligns with the goals of the organization, and you're buying possibly equity or issuing bonds maybe for that organization, or buying bonds of that organization where it aligns with your goals, and that's considered strategic. It's on screen here. If it's a non-strategic, so you just want to generate investment income, it could be debt or equity, versus if it's a strategic relationship or strategic investment because of the relationship desired, it's considered equity. So under ACCT, there are two different types. There are short-term debt investments, which will mature in under 12 months, and there are long-term investments, which will take more than 12 months to mature. So if it's a short-term, it's accounted through the fair value through net income method, versus if it's a long-term bond investment, it's considered at amortized cost. And again, we'll go through a couple of examples today in the lesson, and then we'll do some application exercises later in the week. So if you have short-term investment in bonds, they're typically really easy to buy and sell in the open market. So they are, or they can be, good trading investments. When they're purchased for the primary person of trading, so you buy and sell bonds regularly, they're reported at their fair value. So for that bond value, you always have the original investment or the fair value. So what did you originally pay? You will record any interest earned. You record any changes from the original cost to current market value. So those are typically unearned market adjustments until the date that you realize the gain or loss when the investment is sold. So that's considered fair value through net income. So we have an example here where on October 1st, 2020, Vinyl Sound Company paid $10,500, including brokerage fees of $500, to purchase a portfolio of debt investments, bonds, paying 10% interest intended to be sold within a year. So in this example, we will have a 3-line or a compound journal entry where we have the short-term investment in bonds, because we plan to keep it for about a year, within a year it says, worth a debit of $10,000. We have to record our brokerage fee expense amount of $500 to debit to that. And then we credit our cash because we're actually providing cash for this purchase of $10,500. You can see on the right-hand side of the screen, the categories of impacts. Our cash goes down in current assets, short-term investments goes up, and then we have a brokerage fee expense on our income statement. So then as we move forward, in order to record the interest earned, so let's assume Vinyl Sound's year end is December 31st, and we need to accrue the interest on the portfolio debt securities. So in this case, we have 3 months to pass since the date of purchase. So we'll take the bond face value of $10,000 that we bought of that organization times a 10% per annum interest rate times 3 months out of 12 to determine that our interest revenue for that period was $250, so credit revenue, and we'll debit the interest receivable. Again, you can see our balance sheet income statement on the right-hand side, interest receivable under current assets increases, and our other revenue increases for interest revenue. So then, from time to time, you'll have a fair value adjustment. So let's assume that this portfolio now has a fair value of $11,000 on December 31st. So there's a gain of $1,000. And in the bond market, that typically happens when interest rates drop and you're holding a bond that's paying more than market value. So typically, more than the market standard interest rate. So this one was issued at a 10% rate, which we know is basically impossible to buy today. If that bond had multiple years and you tried to sell it before the maturity date, it would be worth more than the face value. So in this situation, we would mark to market or recognize the unrealized gain as of December 31st. So in this case, we have a new account that shows up under current assets, and this is the valuation allowance. And this could be positive or negative. So if your market value is less than the book value, you would adjust accordingly. So in this example where it's worth more, being $11,000, we have a $1,000 adjustment. So we'll debit the valuation allowance for fair value adjustment, which is sitting in our current assets, and we'll credit the unrealized gain on fair value adjustment, which sits on our income statement under other revenue. All right, so what if we sell some or all of those bonds? And you might have a realized gain or loss. So let's assume on January 15th, a couple of weeks later, Vinyl Sound sells some of the securities in the portfolio. The original securities cost $1,800 and we sold for $2,100. So in this case, we have a realized gain on sale of investment. We have cash coming in of $2,100 debit. We credit our short-term investment on bonds of $1,800, and we have a gain on sale of investment of $300. That's to record the sale of bonds held. All right, now let's move on to long-term investments in bonds. So if we plan to hold until maturity to earn interest revenue, and it's more than 1 year, they're considered long-term investments. These long-term investments are accounted for using the amortized cost method. So that means on the balance sheet, they're reported at their amortized cost. So for these components, there's the acquisition of the long-term investment in bonds. We need to record the interest earned, and we need to record a realized gain or loss when the investment is sold. So let's go through another example. Similar company, we have Vinyl Sound Company purchases $10,000 of investment bonds on October 1st, 2020, and we plan to hold the investment for more than a year. So in this situation, our debit would be to long-term investment bonds for the value of the bonds purchased being $10,000, and we would credit cash because we purchased those bonds for $10,000. And we're holding them, you'll see them on our balance sheet on the right-hand side under long-term investments because we plan to hold more than a year. So when it comes to interest revenue, Vinyl Sound then receives $250 on interest on December 31st. So they receive it. They calculate that they've earned $250, not that they've actually received the cash. Little typo in the wording there. So in this case, we need to debit the interest receivable, because it will come later on, and we'll credit the interest revenue for $250. And the calculations on screen here again, $10,000 face value times 10% coupon rate times the 3 out of 12 months past. You'll see on our balance sheet income statement, interest receivable increases and other revenue increases. So very similar to a short-term investment so far. So then let's look at the last part where we have realized gains or losses. So on January 31st, we sell half the bonds in our portfolio for $4,000. And unfortunately, our long-term investment bonds, half of the original $10,000 investment would be $5,000. So we credit our long-term investment for $5,000. We debit our cash for the $4,000 received. And unfortunately, in this case, we have a debit to our loss on sale of investments because we sold it for less than what it was worth. And you'll see similarly, our balance sheet increases cash, decreases long-term investments, and will increase our other expenses, which decreases our net income for the organization. Let's move over to equity investments then for a bit. So when a company invests our excess cash by buying a portion of another business, it's known as investing in equity instruments or securities. Typically, they're preferred or common shares of another company. And as we mentioned earlier in this chapter review, they can be divided into non-strategic or strategic investments. So we could have a non-strategic investment where it's less than 20% of the outstanding shares. It's considered a fair value through net income accounting process. If we're between 20 and 50% of the outs, or less than 50, but more than 20, we record through the equity method. And if it's a strategic controlling influence, so we own more than 50%, we have to consolidate their financial results into our financial statements. So when we have insignificant influence, we said it's less than 20% owned, and we use the fair value through net income method. So let's go through an example. So we have Vinyl Sound Company again. In this case, we purchased 500 common shares in Wonder Company on January 1st, 2020 at $30 per share. And those 500 shares represent only 1% of their outstanding common. And we plan to hold for more than a year. So in this case, the acquisition, we need to record the debit to long-term investment in shares, 15,000, and credit cash for 15,000. That's to record the 500 common shares. Pretty straightforward for this initial purchase, hopefully. You'll see our long-term assets increase and our current assets cash decrease. So in this case, we received dividend income on those shares that we purchased, and we received $400 in cash dividends on August 31st. So we'll record the dividends when received. We have debit cash, 400, credit dividend revenue, and it's to record the receipt of cash dividend. Now, if they've declared and just didn't pay, you would also record that entry as a receivable, sorry. So then you have a fair value adjustment. So by the year end of December 31st, 2020, the market value of the stock has increased to $35 per share. So we need to calculate the fair value adjustment. So looking at how many shares we purchased times the $35, we have an unrealized gain of $2,500 in this calculation. So we will credit unrealized gain on equity investment, which hits our operating income under other revenue. And then we have a debit to valuation allowance on equity investment for $2,500, which is under a long-term assets section, and it's increasing the value of those long-term investments. Okay, so let's shoot, did I go past it? I apologize. Here we go. So the next one then says, suppose we sell 100 shares of Wonder Company at a price of $38 on February 16th, and we realize only a gain of $3 per share because we already recognized the gain for the year-end difference. So we already recognized some revenue. We just need to recognize the additional. So in this case, we received $19,000. So we'll debit our cash for $19,000. We need to reduce our long-term investment in shares for $15,000 for the 100 shares that we sold. We need to credit the valuation allowance for fair value adjustment for the gain that we recorded at year end. And then we need to credit the gain on sale and investment for the difference of 38 less the $35. So if you break it down into the pieces, you want to keep track of what was your original purchase price, what was the last mark-to-market value, and what's the actual market selling value. Okay, so moving on to strategic investments is where we purchase 20% or more of common shares. Okay. So the plan is to build a long-term relationship with that company. And typically we divide those strategic investments into investments with significant influence and investments with controlling influence, as we mentioned earlier. And under controlling influence, it's consolidation, and significant influence is equity method. So let's first of all talk about equity method. So the equity method is used to report equity investments when we own 20% up to 50, I would say 49.99% of the investee's outstanding common shares. The equity method records the purchase at the original cost and any broker fees, any cost that it takes to buy those shares. And then we account for our share of any net income or dividends declared. So we'll go through an example in a moment. So we need to acquire the investment, we need to record the investment revenue, and then record the dividends received or recognize when the investor becomes entitled to the dividend. So let's go through another example where Vinyl Sound Company purchased 1,000 common shares in this corporation for $400 per share. 1,000 common shares represents 25% of the total outstanding and means that Vinyl Sound has a significant influence over that company. So the original acquisition in this case would be a debit to the investment in Dempton corporate stock for $400,000, 400 times 1,000. And we gave them cash for that purchase of 400,000, so credit cash. Let's move on and let's look at investment revenues. So for that full year, December 31st, 2020, Dempton Corporation has a profit of $200,000. And we own a 25% stake in them. So our profit is $50,000, being 25% of the $200,000 corporate income. So our investment in Dempton corporate stock has increased. So we'll debit that for $50,000 and we'll credit our revenue from investment in Dempton Corporation for $50,000. And that's to record the 25% profit on our equity investment. Moving on, we might have dividends. So in this example, we set off for the year end December 31st, 2020, they declared and paid a $20,000 cash dividend. And our portion will be $5,000, being 25% of the $20,000 cash dividend declared. So in this case, we need to debit our cash, $5,000, and we need to credit our investment in Dempton Corporation just for $5,000. Because remember, dividends are reduced from any net income. So we recorded our share of net income as an increase to that long-term investment. Now we need to reduce that long-term investment by the dividends that were pulled out of the business for our share. So our investment in Dempton stock now, if you look at the bottom of the screen, was a $400,000 original investment, plus a $50,000 share of income for the year, less the $5,000 dividends received. So our investment in their stock is now worth $445,000 on our balance sheet. So for the presentation of investments on financial statements, we need to look at the intent at the purchase date to determine the proper accounting treatment and how it's presented. So for debt investments or bonds, ACCT classifies debt investments either short or long term. Okay, and we'll use Vinyl Sound Company in a minute. Short-term investment in bonds are accounted for using fair value through net income method, which we talked through the example earlier. So we pull up this example again. So on October 1st, 2020, Vinyl Sound Company paid $10,500 to purchase a portfolio of debt investments. We plan to hold them for a short time. So it'll be a short-term investment of bonds. On December 31st, 2020 year-end, Vinyl Sound recorded $250 in interest revenue, and on December 31st, our portfolio of debt investments had a fair value of $11,000. So there was an unrealized gain. Okay, just like the example, just reminding you as we move forward through this presentation. On our income statement, the brokerage fee expense, interest revenue, and unrealized gain on fair value adjustment are all part of the purchasing and recording of that debt investment. And the balances of those accounts, those transactions, need to be reported in the other income and expenses section on the income statement. So just a partial income statement on screen now. We have after the income from operations, and you have the other income and expense section. We would have the interest revenue. Say this is the only investment that we had in bonds. We had $250. We had unrealized gain on fair value adjustment of $1,000, less the brokerage fee expense of $500. So our total other income and expenses was $750 in this case, giving us a new income before income taxes of $765, $750 in this example. For the balance sheet, the valuation for the adjustment needs to be reported on the balance sheet. So you'll see as this partial balance sheet is on screen, we have our cash and cash equivalents, whatever it is, in this case, $70,000. We have our short-term investment bonds at cost being $10,000, and then we have a valuation allowance to record of $1,000. So our short-term investment in bonds at fair value is actually $11,000, as you can see on our balance sheet. All right, so long-term investment in bonds If we classified the $10,000 in debt securities long-term, the company would report this investment using the amortized cost method. And in this case, the investment is not adjusted to its market value. So unrealized gains or losses are not recorded in the journal and thus not reported in the income statement. So the income statement then would not have those other components. So it would have the $250 in their share of interest, but not the mark-to-market component. And since the maturity date is more than 1 year from the balance sheet date, they're classified as long-term. Okay, and they're purchased at par. And under the amortized cost method would be the original investment at par as of the reporting date. So you'll have a long-term investment at amortized cost of $10,000 under a long-term investment section. For equity investments where there's insignificant influence, they're accounted for similarly to how debt or our bonds were, so in the previous example. So the balance sheet would also be similar to debt investments, except any interest receivable would not appear because equity investments do not generate interest, right? Only bonds do. So the equity investment would be classified either as short-term or long-term investment, depending on how long we plan to hold them. Where there's a significant influence, when an investor owns 20 to 50% of the outstanding stock, the investment is recorded at its original cost using the equity method. So if you recall, our example was Vinyl Sound Company. We purchased 1,000 common shares at $400, representing 25% ownership. We recorded the share of profit being 25% of 200,000 or 50,000. And Dempton declared and paid a cash dividend of 20,000, our share being 5,000. So the income statement in this example would look something like this. We'd have the income from operations, 765. And then under our other income and expense section, we'd have revenue from the investment in Dempton Corporation of 50,000. So our income statement. On our balance sheet, if you recall the example we went through, the $400,000 original investment plus the $50,000 share of income less the $5,000 in dividends for their share would give us an investment in Dempton Corporation of the equity method of $445,000. So on the balance sheet partial, that's what would be included under long-term investments. In any investments with controlling influences are consolidated. So you actually add line by line. If they have cash of 100,000, you add it to your cash of your company, Vinyl Sound, in that case. So it's a completely different process there. No special balance sheet accounting. You just treat them as two separate businesses and then roll up and report them all together at the end of the day. So hopefully that helped, and we'll do some examples later this week as well.